Now, after we have discussed the preparation of the consolidated financial statements at acquisition date and 1 year after, now let's proceed to the preparation of the consolidated FS 2 years after the acquisition date. So, the procedure that we are about to perform for this discussion will also apply on the subsequent years in the preparation of the consolidated financial statements. So, let's start. So, the following are the trial balance of Tick and Talk Company as of December 31, 2021, which is the second year after the business combination. So, we have an additional information. During the year, goodwill is impaired by 25 pesos. Then, letter B, on December 31, Talk Company sold half of its equipment with a carrying amount of 140 pesos. So, in the preparation of the consolidated financial statements 2 years after the acquisition date, again, just like I have said in the previous video, all eliminating entries that were prepared since the time of acquisition date will be repeated every year. So, which means that the eliminating entries that we prepared at acquisition date and on December 30, 2020 will be repeated on December 31, 2021. However, as we repeat those eliminating entries, what is important is to reflect the effect of the eliminating entries that we did in the prior years. So it is in your discretion on how your eliminating entries will look like, as long as the net effect of the prior year's eliminating entries must be included every year. So for this period, December 31, 2021. Let's start with the very first eliminating entry that we did, which is the eliminating entry at acquisition date. So if you remember that the eliminating entries that we did at acquisition date, so those are the entries to eliminate the shareholders' equity accounts of the subsidiary, adjust the overvaluation and undervaluation of the subsidiary's net assets, and the recognition of goodwill, and also the elimination of the investment in subsidiary account and the recognition of the non-controlling interests, which is carried at fair value. So this is our eliminating entry that we did as of the acquisition date. Again, all eliminating entries that we are going to prepare for this year are prepared on December 31, 2021. So, in 2020, after we repeated the eliminating entries at acquisition date, we proceeded to the elimination of intercompany transactions and amortization of excess over book value, as well as the recognition of NCI. And we skip the establishment of beginning balances of the consolidated balances of the following equity accounts. So these are the eliminating entries subsequent to acquisition date. So in 2020, why did we skip this part of the eliminating entries? Because in 2020, it is only 1 year after the acquisition date, and the beginning balance of the retained earnings, other comprehensive income, and non-controlling interest is already the January 1, 2020 balance, which is also the acquisition date balance. So which means for the first year, which means that for first year in operation after the acquisition date, this first eliminating entry does not apply. But for 2021, we are already in our 2 years of operations after the business combination. We will now prepare this particular eliminating entry, and that is to establish the beginning balance of the retained earnings, other comprehensive income, and the non-controlling interest for consolidation purposes. So why do we need to establish the beginning balances of the retained earnings, other comprehensive income, and non-controlling interest for consolidation purposes? Because the retained earnings and other comprehensive income that is recorded in the acquirer and the acquiree's books does not represent the consolidated balances if we just get the summation. So because there are adjustments that we made in our prior year eliminating entries that resulted to the consolidated balances. And since those adjustments are not recorded in the books of both the acquirer and the acquiree, we need to reflect the net effect of those eliminating entries that we did in the prior years in order for us to establish the beginning balance of the retained earnings and other comprehensive income. So same explanation also applies for the non-controlling interest. So obviously, the non-controlling interest only appears in the consolidated financial statements. It is not presented in either of the acquirer or the acquiree's separate financial statements. So which means that any entries that we did in the eliminating entries related to the non-controlling interest are not really recorded in any of the books of the entities. That is why we need to reflect the net effect of all entries that we did in the prior years related to the non-controlling interest so that we may establish the beginning balance for the current year. So how do we establish the beginning balances? Again, the consolidated retained earnings and the consolidated other comprehensive income should only be the retained earnings and other comprehensive income attributable to the controlling interest, which means it includes the RE and OCI of the parent in its separate financial statements and its share in the income or loss of the subsidiary. So that is the composition of the consolidated retained earnings and other comprehensive income. So this slide focuses on the retained earnings and other comprehensive income of the subsidiary. Because as to the retained earnings and OCI of the parent, since it is already recorded in the acquirer's books and minor adjustments are needed, our focus is the retained earnings and other comprehensive income of the subsidiary. So at acquisition date, if you remember that the subsidiaries RE and OCI are both eliminated because these are shareholders' equity accounts of the subsidiary. And as always, at acquisition date, all shareholders' equity accounts of the acquiree needs to be eliminated. However, after the acquisition date, the changes or the additions or the deductions to RE and other comprehensive income of the subsidiary is not eliminated. So in subsequent years, any additions to RE, OCI, and any deductions are not eliminated compared to the acquisition date balance. And why is this not eliminated? Because the comprehensive income that is close to RE and OCI of the subsidiary in the years after the acquisition date should be separated into two. So the portion of the income of the subsidiary multiplied by the percentage of ownership of the controlling interest will form part of the consolidated retained earnings and other comprehensive income. So what goes to the consolidated retained earnings or consolidated OCI are the income and loss of the subsidiary that were generated subsequent to the acquisition date. So always remember that any income or loss that is generated by the subsidiary multiplied by the controlling interest percentage will be reported under the consolidated retained earnings and other comprehensive income, if applicable. Then, if we multiplied it by the percentage of ownership of non-controlling interest, it will go to the non-controlling interest account, which is a shareholder's equity account. So which means in order for us to establish the consolidated balance of RE and OCI, which pertains to the controlling interest, we need all the changes that occurred on retained earnings and other comprehensive income in the prior years and multiplied it by the percentage of ownership of the controlling interest. Moreover, for the non-controlling interest, in order for us to establish the non-controlling interest beginning balance, we also need to get the share of the NCI in all incomes and dividends that were reported by the subsidiary in the prior years but subsequent to the acquisition date. So if you will notice that only NCI will be reduced for the dividends it received from the subsidiary, so multiplied by the percentage of ownership. But for the consolidated retained earnings, the share of the controlling interest on the dividends declared by the subsidiary is not part of the amount to be reflected in the consolidated retained earnings. Because again, the consolidated retained earnings should only be reduced by the dividends paid by the controlling interest or the parent. So any dividends paid by the subsidiary will not be reflected on the consolidated retained earnings. So let's start with the eliminating entry subsequent to acquisition date. So first entry would be the adjustment to the beginning balances of the consolidated retained earnings, consolidated other comprehensive income, and non-controlling interest. So based on our problem, we don't have other comprehensive income. What we have is only retained earnings. Only the change in the retained earnings starting from the acquisition date shall be accounted for. Looking at the trial balance of stock company, the retained earnings is 5,240 pesos. And the 5,240 pesos is the January 1, 2021 retained earning balance of the acquiree, because the nominal accounts are not yet closed, because the trial balance is a pre-closing. Because if this is a post-closing trial balance, the retained earnings that will appear is already the ending balance of retained earnings. So again, since this is a pre-closing trial balance, the 5,240 is the beginning balance of retained earnings of the subsidiary. On our eliminating entry, the retained earnings of the subsidiary as of the acquisition date is 4,600, while the January 1, 2021 retained earnings balance is 5,240, which means that the retained earnings of the subsidiary starting acquisition date had increased. That is why we need to distribute the increase to both the controlling interest and the non-controlling interest. Again, using this illustration, the increase in the retained earnings of the subsidiary, which is 5,240 less 4,600, must be distributed to NCI and the controlling interest. So the portion of the NCI will be close to the non-controlling interest account, and the portion of the controlling interest will be recorded in the consolidated retained earnings or the consolidated other comprehensive income. So let's debit retained earnings for 640 pesos. So this is the increase in the retained earnings of the subsidiary starting acquisition date. So this is computed as 5,240 less 4,600. So we debited because we will transfer this to the consolidated retained earnings or the non-controlling interest. So to transfer this is to credit another retained earnings for the 80%, which is 512. So here I used two retained earnings account, so separately for the subsidiary and the parent. But there are eliminating entries that only uses one retained earnings account. But for us to easily understand on how we transfer the increase in the retained earnings of the subsidiary to the controlling interest and non-controlling interest, I will use two retained earnings accounts separately for the subsidiary and the parent. So out of 640, 80% is to the controlling interest. So that is why we credited the retained earnings of the parent at 512. Then the remaining 20% will go to the non-controlling interest for 128 pesos. So after this eliminating entry, the 640 now is distributed to the controlling interest and the non-controlling interest. However, this will not yet result to the beginning balance of the consolidated retained earnings and the non-controlling interest, because the 640 peso increase is only based on the records of the acquiree in its separate financial statements. And if you can remember that the net income or net loss of the subsidiary recorded in its separate financial statements is not necessarily also the net income or loss of the subsidiary for consolidation purposes, because there are adjustments that we made to its net income. So this is only the change in the subsidiary's RE or OCI. So in this case, this is only retained earnings. So in order for us to establish the beginning balance of the consolidated retained earnings and non-controlling interest, we need to make some adjustments on the 640 increase book value of the subsidiary. And what are these? These adjustments are the prior year's amortization of excess that we did. So in our eliminating entry on December 31, 2020, if you can remember, these are the amortization of excess that we did. So this relates to the inventory, equipment, building, patent, premium on bonds payable, and non-operating expense. These are only working paper entries. It is not reflected in the books of the subsidiary. So these are the adjustments that we did in the net income of the subsidiary. And again, on December 31, 2021, the beginning balance of the retained earnings and non-controlling interest should reflect these adjustments made in the prior years. So this is the amortization that we did in 2020. So this must be reflected in the beginning balance of the consolidated retained earnings and non-controlling interest. So the net adjustments that we made has an effect on the net income of the subsidiary of 45 pesos. So this is an increase. So we increased the net income of the subsidiary as recorded in its books by 45 pesos. So which means that the consolidated retained earnings must include an 80% of the 45 pesos, and the non-controlling interest must include the 20% of the 45 pesos. So the 80% of 45 is 36 pesos, and the 20% of 45 is 9 pesos. So which means that the 36 pesos will be part of the consolidated retained earnings beginning balance, and the 9 pesos will be part of the beginning balance of the non-controlling interest. So on the left side, these are the eliminating entries that we did in 2020. Now we are going to repeat these in 2021. So if you will look into these entries, the eliminating entries both uses real and nominal accounts. For the real accounts, the same entry will apply during the current year eliminating entries. However, for the nominal accounts, for the prior year period, will not be recorded again under the nominal accounts for the current year period. Instead, the nominal accounts will be replaced with the retained earnings and the non-controlling interest. So for the prior period, amortization of excess over book value, our entry will be a debit to inventory for 4 pesos. So the inventory is debited at 4 pesos because inventory is a real account. Then the other accounts will be accumulated depreciation is debited at 2 pesos because here the accumulated depreciation, which is a real account, is debited, as well as the building, it is also debited. Then the patent is credited for 3 pesos because here we credited also patent at 3 pesos. And the goodwill is 10 pesos as a credit. Then for the liability, the premium on bonds payable is debited for 10 pesos. So if you will compare these two, the entry that we did for the real accounts in the prior year is also the same entry when it will be repeated during the current year. However, for the nominal accounts, we will replace this by retained earnings and non-controlling interest. So the net effect of the amortization in the prior year is 45 pesos. And as we divide this to controlling interest and non-controlling interest, the consolidated retained earnings shall increase by 36 pesos, which is 80% of 45, and the non-controlling interest will increase also by 20%, which is 9 pesos. That is why here in our entry during the current year, the retained earnings is credited at 36 pesos. So this is the retained earnings pertaining to the controlling interest. So this is credited because the 45 peso net effect of amortization in the prior year is an increase. And the non-controlling interest is also credited for 9 pesos because increasing non-controlling interest is a credit to NCI. So let's check whether after these eliminating entries, the consolidated retained earnings and non-controlling interest beginning balance are now established for January 1. So let's start first with the consolidated retained earnings. Again, the composition of the consolidated retained earnings is the retained earnings of the parent for consolidation purposes, and the increases in the subsidiaries' retained earnings subsequent to the acquisition date. So for the parent's contribution or the parent's portion on the consolidated retained earnings, we will get the parent's retained earnings in its separate trial balance, which is 6,750. So the 6,750 is the beginning balance of retained earnings of the acquirer. Then, for the non-controlling interest, we will establish the acquisition date balance, which is the result of our eliminating entry. The acquisition date balance of the non-controlling interest is 1,440, and this will reflect in the consolidated working paper through the eliminating entries at acquisition date. Now, let's proceed to the adjustments that we made subsequent to acquisition date, and those are the share in the increase in the subsidiaries' retained earnings. So the controlling interest, the share is 512 and the share of the NCI is 128. So we get the 512 from our entry here as the change in subsidiaries RE, and the 128 is for the NCI. Now, let's proceed to the prior period amortization of excess over book value. So the share of the parent is 36 pesos, and for the non-controlling interest is 9 pesos. So again, the 36 pesos is from the eliminating entry and the 9 pesos. So the total amortization of excess in 2020 is 45 pesos. Now, let's get the balance. For consolidated retained earnings, 7,298. For the non-controlling interest is 1,577. So these are the consolidated balances as of January 1, 2021. So if you will check the ending balance of our December 31, 2020 for consolidated retained earnings and non-controlling interest, the amount is 7,298 and 1,577. So this is our December 31 working paper. As we see here, the retained earnings is 7,298 and the non-controlling interest is 1,577. So after the eliminating entries that we did, we now establish the beginning balance of the RE and non-controlling interest. So after we establish the beginning balances of these accounts, let's now proceed to the other three eliminating entries for the current year. So these are the elimination of intercompany transactions, amortization of excess over book value related to the current year, and the recognition of the non-recognition of the non-controlling interest share in the subsidiary's net income for consolidation purposes. Now let's start with the current year eliminating entries. First is the elimination of intercompany transactions. So again, our only intercompany transaction based on the data is the dividends paid by the subsidiary to the parent company. So here, the dividend paid by the subsidiary is 240 pesos, and 80% of this is the dividend income of the acquirer, which is 192 pesos. And since this is an intercompany transaction or transactions within companies that are considered as a single economic entity for consolidation purposes, we need to eliminate this. So let's start with elimination of intercompany transactions. So the debit will be to eliminate the dividend income. So dividend income is debited for 192 pesos and dividends paid is credited for 240 pesos. And the difference is 48 pesos, which will be debited to non-controlling interest. Again, this non-controlling interest is the portion of the subsidiary's shareholders' equity that is attributable to the 20%. That is why every movement in the subsidiary's shareholders' equity should have a corresponding change also in the non-controlling interest account. And since dividend payments will result to the decrease of the subsidiary's shareholders' equity, the non-controlling interest should also be decreased, however, only at 20%. So for this dividend, at 48 pesos. Now let's proceed to the amortization of excess for the current year, 2021. So here, this is an extended amortization table that we did in 2020. So I've added another column for 2021. So if you can see that the amortization only includes the equipment, building, patent, and bonds payable for the fair value changes and the goodwill. The inventory is no longer included in the 2021 amortization because the difference between the fair value and the book value of 4 pesos is already amortized in full in 2020. So which means there is no 2021 amortization related to inventory. So for equipment, building, patent, and bonds payable, since we are using the straight line method of depreciation and amortization, so the amount of amortization that we computed in 2020 is also the amortization for 2021. However, for goodwill, the impairment in 2021 is 21 pesos. So here, the net effect of the 2021 amortization on the subsidiary's net income is an increase of 30 pesos. So for the current year amortization of excess over book value, our entry would be, so this is our entry. So this is a compound eliminating entry. So we debited accumulated depreciation for equipment and building and premiums on bonds payable, credited patent and goodwill. So for these accounts, so for the real accounts, these are also the entry that we did in 2020. So the accounts debited here are also the accounts debited in 2020, and the accounts credited is also the accounts credited in 2020. Then we debit non-operating expense. So the non-operating expense pertains to our premium on bonds payable amortization and the impairment of goodwill, while the operating expense includes the depreciation of 2 pesos, 42, and the patent amortization. So aside from this eliminating entry in the amortization of excess, we have an additional information, letter B, which is on December 31, 2021, so exactly at the end of the current year, Talk Company, the acquiree, sold half of its equipment with a carrying amount of 140 pesos. So looking at the trial balance of Talk Company, we have a 200 equipment, which is the cost, and accumulated depreciation of 60 pesos. Which means that prior to the sale, the equipment has a total cost of 400 and an accumulated depreciation of 120 pesos. So since half was sold, so the remaining cost is 200 and the remaining accumulated depreciation is 60 and the carrying amount is 140 pesos. So in the amortization of excess related to depreciable assets, we amortize the excess through depreciation. However, when the depreciable assets is sold prior to the end of the useful life, any remaining unamortized excess related to the depreciable assets shall be amortized in full during the year of sale. So the equipment was sold in 2021 year end, and the difference between the fair value and the book value is 18 pesos. However, the 18 peso difference is not yet fully amortized because as we expect that the 18 peso difference will be fully amortized at the end of 9 years estimated useful life. And as of the end of 2021, through depreciation, we only amortized 4 pesos, which is 2 pesos in 2020 and another 2 pesos in 2021. So, for this reason, there is a remaining unamortized difference of 14 pesos, which is 18 less 2 pesos and less 2 pesos. So, the remaining unamortized difference is 14 pesos. But only half of the equipment was sold, which means out of the 14 peso difference, only half of which must be fully amortized because the half of the equipment is sold in 2021. Based on the trial balance, the acquiree has a gain on sale of equipment for 15 pesos. And since the carrying amount per books of the acquiree is 140 pesos, which means that the cash proceeds from the sale is 155 pesos or 140 plus the gain of 15 pesos. So for consolidation purposes, the gain on sale of equipment is not 15 pesos because in the consolidation, the equipment of the acquiree is not valued at 140 pesos because the 140 peso carrying amount of the acquiree in its separate financial statement is based on the book value of the acquiree. However, the equipment of the acquiree in the consolidated FS is valued at acquisition date fair value. Hence, when we compute for the gain on sale of the equipment of the acquiree for consolidation purposes, the carrying amount that is considered is the depreciated acquisition date fair value. So which means that the gain on sale of equipment will change. So the eliminating entry is debit accumulated depreciation for the remaining unamortized excess related to the equipment, which is 7 pesos. Again, the unamortized excess for the equipment is 14 pesos. However, only half was sold. That is why only 7 pesos must be fully amortized. Then our credit is 7 under the account gain on sale of equipment. So after this eliminating entry, the gain on sale of equipment that will appear in the consolidated financial statement is 15 pesos plus 7 pesos or 22 pesos. Now, let's check whether the gain on sale for consolidation purposes is actually 22 pesos. So in the books of the acquiree, the gain on sale is 15 pesos, which is computed as 140 deducted from 155 pesos. For consolidation purposes, the cash proceed is still at 155 because this is the actual selling price. However, for consolidation purposes, the carrying amount is not 140. Instead, it is 133 pesos. And how is this computed? This is computed by 342 pesos, which is the fair value at acquisition date of the acquiree's equipment, divided by 9 times 7. 7 years is the remaining estimated useful life as of December 31, 2021. And since only half of the equipment was sold, we divided it again by 2. So which means that the carrying amount of the half of the equipment for consolidation purposes is 133 pesos. So 155 less 133 is 22 pesos. So for consolidation purposes, the gain on sale is 22 pesos. So after we're done with the elimination of the intercompany transactions and amortization of the excess over book value, now let's proceed to the last eliminating entry, which is to recognize the share of the non-controlling interest in the net income of the subsidiary for consolidation purposes. So the net income of the subsidiary in its separate financial statement is 110 pesos. So how is this computed? This is the sale of 1,385 less cost of sale of 700, add the gain on sale of equipment of 15 pesos, then deduct the operating expense and non-operating expense. That is why the net income per books of this subsidiary is 110 pesos. And since we have eliminating entries related to the current year period, there are adjustments made to the subsidiary's net income. So the 7 pesos is our adjustment to the gain on sale, which is the full amortization of the fair value difference related to the equipment, and the 41 pesos is the operating expenses in our entry, and for the non-operating expense is the 15 pesos in our eliminating entry. So our net income of the subsidiary for consolidation purposes is adjusted to 143 pesos. And get the 20% share of the NCI, this is 28.6 pesos. So the share of the NCI in the net income of the subsidiary as adjusted is 28.6 pesos. So as a result, our entry is to debit share of NCI in subsidiary's net income for 28.6, then credits for the same amount under the account non-controlling interest. Again, since income will increase the subsidiary's shareholders' equity, there should be a corresponding increase in the non-controlling interest account. So to summarize the eliminating entries, these are the eliminating entries that we prepared on December 31, 2021. So first is the eliminating entries at acquisition date. Then, subsequent to acquisition date, before we prepare the current year eliminating entries, is we recognize all the changes in the retained earnings and other comprehensive income of the subsidiary. So that is the adjustment to the beginning balance of the consolidated RE, OCI, and the NCI. Then, after we adjust the beginning balances, we now proceed to the current year eliminating entries. So this includes the elimination of intercompany accounts, the amortization of excess for the current year, and recognition of NCI in the share of subsidiaries' net income. So if you will notice, all accounts related to the acquisition date eliminating entries and the adjustment of beginning balances are all real accounts. There are no nominal accounts here. So which means when we posted these entries in the working paper, only the balance sheet accounts will be affected. Then for the current year eliminating entries, this pertains to the adjustment of the nominal accounts of the parent and the subsidiary. So that is why for the current year eliminating entries, there is an effect on both real accounts and nominal accounts. Now, let's proceed to the preparation of the working paper to facilitate the preparation of the consolidated financial statement. So let's start with the working paper. So all the account balances in the trial balance of both the acquirer and the acquiree must be transferred to the working paper. So starting with the income statement. So the net income of the acquirer in its separate financial statements is 1,607, and for the acquiree is 110 pesos. And since I am using the single statement for the income statement and changes in retained earnings just for the working paper, the ending balance of the retained earnings is 8,057 pesos, and the retained earnings ending balance in the separate books of the acquiree is 5,110. Then for the assets, the total assets of the acquirer is 15,642. as well as its total liabilities and shareholders' equity. Then for the acquiree, so these are the balances of the asset accounts and these are the liabilities and equity accounts. Then take note for the retained earnings, this is the retained earnings ending from our single statement above in the upper section of our working paper. So that is for the parent and this is for the acquiree. So let's start our working paper. So again, the eliminating entries, I've divided it into three. The acquisition date eliminating entries, the adjustments of our beginning balances for retained earnings, other comprehensive income, and non-controlling interest, and the current year eliminating entries that has an effect on both the real and nominal accounts. Again, acquisition date entries and the eliminating entries to adjust the beginning balances are all real accounts. So let's start with the acquisition date eliminating entries. So these are the eliminating entries at acquisition date. So the debits and credits are balanced. So next is the adjustment of beginning balance. So the adjustment of beginning balance after we posted, so these are the eliminating entries. So again, if you will notice that the acquisition date and the adjustment of the beginning balances eliminating entries only affects real accounts. Then for the current year eliminating entries, this will have an effect on both nominal and real accounts. So the income statement accounts are also adjusted as well as the real accounts. Again, I've used a formula for this so that it can be easily posted, all the entries in our working paper. But I suggest that on your part, you prepare this on a manual format. Then by posting the eliminating entries one by one on your working paper. Because in that way, you will more understand the process. Then now let's proceed to the consolidated balances. So let's start with the income statement. So the income statement is, so the consolidated net income is 1,558. So this is the summation of the net income of the acquirer and the acquiree, but subjected to the eliminating entries for the current year. Then out of 1,558 consolidated net income, 28.6 is related to the non-controlling interest. That is why the share of the controlling interest in the consolidated net income is 1,529.4. Then, less dividends payment. Again, the dividends paid that is deducted in the consolidated retained earnings is always the dividends paid by the parent. So that is why only 300 is deducted here. Then the retained earnings beginning in the consolidated financial statement is 7,298. So this is the amount that we have established because of this entry. So this is the entry, that is why the beginning balance is 7,298. So the retained earnings for the year ending December 31, 2021 is 8,527.4. Then now let's proceed to the balance sheet starting with assets. So the assets has a total of 21,764. So we have no investment in subsidiary and the goodwill again is reduced because of the impairment we recorded in 2 years. Then the liabilities and equity also has a total of 21,764. Again, the ending retained earnings here of 8,527.4 is the ending balance of RE in the upper section of our working paper. Then the gain on sale is already 22. So this is the consolidated gain on sale as we adjust the full amortization of the excess related to the equipment sold. So here, based on this working paper, we can now prepare the consolidated financial statements. So this is the consolidated income statement. Then this is the consolidated statement of financial position. Now let's start preparing the consolidated statement of changes in shareholders' equity. So our accounts are share capital, share premium, retained earnings, non-controlling interest. So these are the composition of shareholders' equity in the consolidated financial statements. So let's start with the January 1, 2021 beginning balance. So the share capital has a beginning balance of 2,000 pesos. The share premium has a beginning balance of 500 pesos. The retained earnings is 7,298. The non-controlling interest is 1,577. So the total shareholders' equity beginning balance is 11,375. So these amounts are the ending balance in the December 31, 2020 consolidated financial statements. Now, since there are no transactions affecting the contributed capital, the share capital and share premium, let's proceed to the transactions affecting retained earnings, starting with the consolidated net income. So the consolidated net income in our working paper is 1,558. So the share of the controlling interest or the parent is 1,529.4, while the non-controlling interest has a share of 28.6. Now let's proceed to dividends. The dividends paid that will be deducted from the consolidated retained earnings is always the dividends paid by the parent. So that is 300 pesos. Then for the non-controlling interest, since non-controlling interest is a portion of the subsidiary's shareholders' equity, therefore, any movements in the shareholders' equity of the subsidiary should also have a corresponding movement to the non-controlling interest account. However, only up to the extent of its ownership. So there is dividends paid by the subsidiary, and the dividends will decrease the shareholders' equity of the subsidiary. Therefore, the non-controlling interest should also decrease only up to 20%, and that is 48 pesos. Now, let us determine the ending balances since there are no more transactions in the equity accounts. So the ending balances is 2,000 for the share capital, share premium is 500, the consolidated retained earnings is 8,527.4, the non-controlling interest is 1,557.6, and the ending balance of the consolidated shareholders' equity is 12,585. So these are now the consolidated balances. So the financial statement will include the consolidated income statement here, only up to 1,529.4, which is the share of the controlling interest, and the statement of financial position here in the consolidated financial statement. And the consolidated statement of changes in shareholders' equity is this part. So always ensure that the ending balances of retained earnings and non-controlling interest will equal to the amount presented in the working paper or the statement of financial position. So this ends the discussion on the preparation of the consolidated financial statements subsequent to acquisition date.